Hello everyone, welcome to the second part of the consolidation activity. Remember, in the last video we were looking at the CRJ, the DJ as well as the DAJ. Now this is the final part of that activity that I want us to do. So we are going to do the analysis of transactions or the accounting equation, okay, to see how the double entry principle should be applied. Okay, so let us continue. So it says complete the following table for transactions on the 7th, the 14th, the 19th as well as the 25th. Okay, so we are going to do that. So let us look at all those transactions. Let us start with the transaction on day 7. So with day 7 it said sold goods on credit to Gonga for 1,525. so it's a credit sale. Okay, so when there's a credit sale, we have to name the source document. The source document is the duplicate credit sales invoice. It's long, but you can just say credit invoice or invoice, it's fine, but it's the duplicate because the business will keep the copy and the customer will get the original always. The journal that we use, the DJ, remember all credit sales are recorded under the DJ. So let us do the general ledger quickly. So I have a quick way of recording this and it works, okay, but I think I'll get into more details or explain it further in other videos, but for the sake of this activity I'll give you what actually works. So normally I use an acronym for credit sales, so I'll write it here. So for credit sales, I'll say number 1, when there is a credit sales or goods sold on credit, I use the acronym DSCT. Okay, DSCT is don't sell cookies today. It's actually nice. Don't sell cookies today. So I know every time I am asked to do the general ledger and write the accounts that are affected, I just say DSCT, which stands for debtors control. Okay, so it's going to be DSC and T. Those are my accounts that are affected. So it's going to be debtors control, don't have space, sales, cost of sales, as well as trading, stock. So always when the business sells goods on credit, debtors control account is affected, your sales account is affected because you're earning money, cost of sales is affected because of goods are going out, as well as trading, stock. It's always like this, guys, always. Okay, the other thing that I want us to do is the effect. So I know debtors control is an asset, sales is an income, cost of sales is an expense, trading stock is an asset. Okay, So I know that if I'm putting my debtors control on the debit, which is an asset, my assets are increasing. If I'm putting my incomes on the credit side, that means my incomes are increasing. If I'm putting my expenses on the debit side, I know that my expenses are increasing. If I put my trading stock, which is an asset, or I put my assets on the credit side, I know that my trading stock is, or my assets are decreasing. So this is how you show the effect, guys. This strategy works. So I know I have an asset. So if I have an asset, I know my assets are increasing. Okay, because debtors control is increasing. Incomes are increasing. So you know the rule. When incomes go up, I'll write it here. When incomes increase, owner's equity also increases, because that tells us that the profit of the owner increases. The more income you have, the more profit you are likely to have. So it's also a plus. And guys, remember, this is an accounting equation. Okay, assets equals to owner's equity plus liabilities, so it should always balance. So if you have a plus this side, you should also have a plus on the other side. Okay, and the amounts should also be equal. So let's start. Which amount are we going to record for the first one? We are going to record the selling price amount. Why? Because of that is actually the amount of money that you earned from selling the goods, and that is actually the amount of money that your debtors now owe you or owe to you. So it's 1,525. It's right here. Let me move it down so that you can see 1,525. Okay, so that is the amount that I earned. So it's 1,525. 1,525. So that is the first step. The first step, 0, no effect on liability. So the first step is to record how much did you earn and how much are you now what is the amount that your debtors are now owing you. Okay, and then the next step with this transaction, you record the stock, or you account for the stock that was sold. Okay, so assets are always recorded at cost price, or trading stock is always recorded at cost price. So you need to find the cost of the trading stock that was sold. That is your cost of sales. So you use the cost price amount. What is the cost price amount? We already found it. Remember? Yeah, we already calculated it. So the stock is going out, but before we do that, let us check the accounts. So I debited an asset account, which is trading stock, and if I credited my account, my asset account, which is trading stocks. So that means my assets are going down by how much? The cost, always the cost, guys, minus 1,220, and then my expenses are increasing. So cost of sales is an expense, it's increasing, but what's the rule? If my expenses are increasing, owner's equity is decreasing. The more expenses you have, the less profit you're going to make. So it's also a minus under owner's equity, 1,220. Then 0 under liabilities, no effect. Okay, and let us move on to day 14. So day 14, it says received an EFT from El Khasi to fully settle her account. So we received money from a debtor. We did not sell any goods or any stock. We received money. Okay, so source document that was issued out, it's a duplicate receipt. So we issued out an original receipt to the customer, and we kept the duplicate, the one that we are going to use as evidence that we received money. So this the journal CRJ, So we received money. Every time you receive cash, I mean, bank is the main account. So what's happening to your bank? It's increasing, and bank is an asset. So assets increase on the debit side. So I know that my bank is increasing. I will put a plus because it's an asset. By how much? How much did we receive? Was it day 14? Yes, day 14. Remember day 14? It's the money received from El Khasi. It's here. It's 480. So it's going to be 480. So it's going to be 480 here. And then what's the other account? Debtors control. It's right there. It's the other account. Because now a debtor is reducing their account. Remember, a debtor took goods. We debited debtors control account. Now the debtor is paying his account. That means the debtors control account is decreasing. So I'm going to say debtors or debtors control, which is also an asset. So this asset is decreasing. So I'll write minus here. It's the same amount. So it's plus minus 480. So because of both of them are assets, so there's no effect under equity as well as liabilities. Okay. And then moving on, so we are done day 7, day 14. Let's go to day 19. So day 19, what happened? Day 19, remember, day 19 there was a cash sale. Okay, so we received money for the goods sold cash. Okay, so it's a cash sale. So again, I have an acronym for cash sales. For cash sales is BSCT, which stands for bring some cookies today. Bring some cookies today. Don't sell cookies today. So this one is bring some cookies today. So I know every time there is a cash sale transaction, I know that I have to write this acronym down. But let's firstly start with the source document. So the source document is cash register roll. Sometimes they can say cash register tape or till slip. It's still fine. Journal that we use, CRJ, cash receipts journal. So let's apply our acronym. It's BSCT. So the B stands for bank because of we received cash and made an income. The goods went out, cost of sales, trading stock decreased because of goods were sold. Okay, bring some cookies today. And then your bank is an asset. If an asset is debited, that means your assets are increasing. Sales is an income. If your incomes are credited, they are increasing, so it's plus. Cost of sales is an expense and it's increasing, but if expenses are increasing, owner's equity goes down, so it's minus. Trading stock is an asset. If it's on the credit, that means assets are decreasing, so it's a minus. So it's always like this, né? And then how much did we receive into the bank account as our income from selling goods? 600. Okay, so 600. So 600 this side, 600 on the other side, no effect under liabilities. And then how much stock went out? What is the cost price of the stock that went out? We have already calculated the cost price. So let us go to our CRJ, remember the cost price was 480. It's 480. So that is the cost price of the goods that went out. So 0 under liabilities. And then the last one, day 25. So we are done with day 19. Let's go to day 25. Day 25 says El Khasi returned damaged goods worth 300. Credit note number 3 was issued. So I also have an acronym for this one. I'll write it here, number 3. So this one is a reversal of a credit sale. I mean, the goods were returned. But let me give you the acronym. Returns. Then I'll write it as returns by debtors. Is D T C. Okay, what does it stand for? Oh, I forgot to use the red color. Okay, what does it stand for? It stands for don't drink that Coke. Nice, eh? Don't drink that Coke. So how do we apply it? Firstly, let's start with the source document that is issued out when goods are returned. So it's a duplicate. Credit note. Okay. The name of the journal that records returns is DAJ. So let's apply our acronym DDTC. The D stands for debtors allowance. Debtors allowance is the account for that records all the returns from debtors. And then debtors control. Remember, debtor is returning the goods, so debtors control should be there. And then trading stock, but this time trading stock is on the debit side, and then cost of sales is on the credit side. Let us analyze. So debtors allowance is an expense. The business, is losing the income that it had made, so they have to cancel it. So it's treated as an expense. So this expense is on the debit. That means it's increasing. But we know that when expenses are increasing, owner's equity is decreasing. And then debtors control is an asset because debtors are returning the goods. That means the amount that they owe to the business gets reduced. Okay, so it's minusing. So it's minus under assets as well. And then trading stock is an asset, but this asset is on the debit, so it's a plus because the trading stock that had initially left is now coming back, so it's increasing. Okay, because now the trading stock is back, but when it's sold it's going to be on the credit side, but when it comes back it's going to be on the debit side. Okay, and then cost of sales is an expense, but look at this. This expense is on the credit side, but we know that expenses decrease when they're on the credit side. Again, so assets are increasing, but expenses are decreasing. It's the opposite of increasing here from the first one. So when expenses are decreasing, the owner will make more profit. So owner's equity will go up. Ne? So that means it's a plus. Can you see the signs are the same on these two sides? Okay, debtors allowance. So it's this transaction right here that we recorded under the DAJ. Okay, so the debtors allowance, the selling price of the goods that were returned is 300, and then 300 there. And then for trading stock, you always use the cost price or the cost of sales amount, which is the 250. 240. So the cost is 240 of the trading stock that is coming back. So our trading stock increased by 240, and then our profit also increased by 240. Okay, and then we are done. Thank you, guys.